Unlocking the potential of index funds. Tailored strategies for every investor stage. Index funds have emerged as a cornerstone of many investment portfolios, offering simplicity, diversification, and typically lower costs compared to actively managed funds. Whether you are a fledgling investor stepping into the financial world, a seasoned individual refining your investment strategy, aspiring for early retirement, or on the verge of retirement, understanding the fundamentals of index funds and their diverse investment options is pivotal. In this article, we explore the basics of index funds, delve into the various types available, and discuss tailored investment strategies for investors at different stages of their financial journey. 1. Basics of index funds. Index funds are passive investment vehicles designed to replicate the performance of a specific market index, such as the S&P 500 or the Nasdaq 100. These funds aim to mirror the composition and returns of their chosen index rather than relying on active management by fund managers. 2. Different types of index funds. A. Broad market index funds. These funds track broader market indices like the S&P 500, which covers a wide range of large-cap U.S. stocks. B. Sector-specific index funds. These funds focus on specific sectors such as technology, healthcare, or energy, offering concentrated exposure to a particular industry. C. International index funds. These funds track indices from global markets, providing exposure to international stocks outside the investor's home country. D. Bond index funds. Bond index funds follow fixed income indices and invest in a variety of bonds, including government, corporate, or municipal bonds. 3. Investment strategies for different investor profiles. A. New investors. Strategy. Start with broad market index funds. New investors should begin with broad market index funds like those tracking the S&P 500. These funds offer diversified exposure to the overall market, minimizing risk. B. Experienced investors. Strategy. Combine different types of index funds. Experienced investors can diversify their portfolios by combining various types of index funds. This might include a mix of broad market indices, sector-specific, or international index funds. C. Investors aiming for early retirement. Strategy. Emphasize growth-oriented index funds. Investors aiming for early retirement might lean towards growth-oriented index funds that track indices with higher potential for capital appreciation, such as tech or emerging markets. D. Investors nearing retirement. Strategy. Prioritize stability and income. Investors nearing retirement should focus on stability and income. Bond index funds or dividend-focused indices can provide steady income and reduced volatility. 4. Risks and considerations. Tracking error. Index funds may not perfectly mirror the performance of their underlying indices due to tracking errors. Market volatility. Index funds are susceptible to market fluctuations and can experience losses during downturns. Expense ratios. While generally lower than actively managed funds, index funds have expense ratios that impact overall returns. Conclusion. In conclusion, index funds offer a straightforward and cost-effective way to build a diversified investment portfolio. Whether you are a novice investor, a seasoned individual, aiming for early retirement, or nearing retirement, there is an index fund strategy tailored to suit your financial goals. By understanding the nuances of index funds and aligning your investments with your unique objectives, you can potentially achieve greater financial stability and growth over the long term.